for the most part, it seems that we have the market interpreting the rate hold by the central bank as an indication that the high interest regime is going to continue over in Kenya. Of course, that's what the strength in the local unit is being attributed to at this stage of the game. What's your view on that decision that came through this week?
I think it was a pretty good decision, especially if you look at, as you mentioned, what happened across the border in Uganda. If they had brought down the CBR even probably by a marginal level of about 50, maybe 75 beeps, we may have seen a knee-jerk reaction from the market with our shilling weakening, and also probably with rates also coming off a bit too fast. So I think it was a pretty good decision, especially if you look at inflation and the threats to inflation, which are becoming very real as the days go by, especially if you look at, of course, they're the ones we can't control, the external shocks such as global fuel prices because of what's going on in the Middle East, and also locally, we also, the meteorological department also warned about the weather for the year 2012. And if you consider that energy and food make up about 54% of our CPI basket, I mean, this is quite a real threat going forward.
Of course, the threat coming from that inflationary risk that presents itself, but also from the shilling. Yes, it's off those highs that we saw last year, Ken, but I mean, the central bank has been buying dollars from the market in order to keep this unit stable. Last week, traders saying they'd seen the central bank looking to buy dollars around that 82, 82.50 level, with the unit sitting at 82.70, around about that level at this stage of the game. What kind of trading range have you pegged out for the local unit?
Basically, of course, you know, it's been trading range bound between about 82.50 and 83.90 for about the last 8 weeks or so. Going forward, I think as we move towards the end of the financial year, we may see indications are that we may see the shilling weaken to about levels of 85. I mean, there are actually indications coming from the central bank, not confirmed, but that they may stop playing the market. So we may see it weakening to about 85 shillings towards the end of this financial year. That's towards the end of the close of this quarter.
That having been said, if we're looking at other supporting factors for the local unit, offshore investors to the market have come in a big way, where yields on government securities are staying fairly high in the medium term. What kind of activity are you seeing on that front when it comes to offshore interest in the fixed income market?
There's actually been, yes, quite an increase in offshore interest chasing our treasury yields. We've seen probably 1 or 2 big offshore clients bringing in money, especially into the infrastructure bonds and the 1-year treasury bonds. Although going forward, for example, MLF is today, we're expecting them to issue a 3 to 5 year paper. We may not see so much FDI inflows enough to affect the shilling long term. Probably that is towards the end of the quarter. So yes, this has supported the shilling somewhat, especially if you look at the shilling's performance when value dates for these bonds have been. That's since about February. Yes, we have seen an effect on our local currency.
This in the face of what kind of interest in the bond market from local investors, Ken?
Local investors, of course, have been playing the market. It's been a wonderful, I'd say, 3 weeks for the secondary bond market. Most of them were waiting for the MPC meeting that happened on Tuesday. If the CBR had come off, we would have seen the rates, I mean, probably move down a lot faster. Now what we actually think we may see is the decline may slow down. Of course, yesterday the 364-day T-bill came off by about 300 basis points. But I think this is the largest spread we'll see for quite a bit. Now, what will happen in the market is most investors are taking a position that the CBR may come off, and this in turn will filter through to the secondary market. But since it was held where it is, we may see activity begin to falter off somewhat. I mean, I think it was also a driving factor if you look at the equity market. A lot of investors were also hoping if the CBR comes off, we may see a drop in interest rates, which means investors will begin to look more at the equity market. So we may see this also affect both markets in terms of activity activity may slow down from what we've seen for the last 3 to 4 weeks.
So just recap for us on the yield front there. I mean, in terms of movements where there's this probability of a decline, of a slowdown in rates, we've got rates that might hold, rates on hold now might be slowing down that probability of coming down as quickly as it would have if the central bank had cut rates earlier this week, right?
Yes, that's actually true. Of course, we do expect they'll still come off, not at such a steep incline as expected earlier. Yeah. And especially if you look at the prime rates, we expect they may come off and maybe stabilize at levels around 15%.
In terms of news flow that may well affect sentiment, Ken, yesterday we had a majority of Kenyan lawmakers voting to clear Central Bank Governor Njuguna Ndung'u of any responsibility over the local unit's plunge to a historic low last year of, 107 shillings against the dollar. What did you make of that news flow and that outcome that's filtered through?
I think the outcome was expected, and although we have a bit of legislative pressure and legislative risk coming from Parliament, we don't expect this to really filter through to the markets, both the fixed income and currency market. What may affect the currency especially is if we have if, for example, Treasury or CBK come out and make a statement, or roadside statements as they're called. But in terms of legislative pressure, which we've also seen on interest rates, where they've been pushing for the banks to have a certain base lending rate pegged on the CBR. This has actually not affected the market at all, and going forward, I actually don't expect it to go through.
At this stage, where are your confidence levels sitting with regards to the Central Bank of Kenya and the direction it's on and pursuing with regards to policy?
I think the policy is actually wonderful. As I said, it's a great thing that they held the CBR where it is. The monetary policy has really been working, especially also with support from the fiscal side. As you know, the Minister of Finance back then had implemented some measures to curtail expenditure. So, as long as fiscal policy supports the monetary policy, we expect this tightening to keep filtering through further down to the real economy. But going forward, I think the second half is not so clear, because now we'll have a totally new fiscal policy with implementing a new structure of government that will be quite robust, and we may see a lot of pressure coming on rates then, upward pressure actually.